Hey there, this is George. I hope you all are doing great. This is the second part of analyzing the electric car industry and its leaders. In the last video I talked about how Tesla has grown in recent years, its finances and ratios, and its plan for the future, so that you have more information about the industry and the company and know if they could be an investment opportunity for you. It's clear that Tesla is one of the strongest leaders right now, and therefore the one with the least risk to invest your money in. But there are some other competitors that are emerging in the industry with good growth potential. Today I'm not going to talk about Tesla, but about its closest competitors that are exclusively dedicated to the production of electric vehicles in this industry. These are Auto and BYD. These companies operate in the Chinese market. The Chinese economy is advancing like never before and is betting heavily on everything related to new technologies that will change the world to make everything around us simpler and more efficient. China right now is the country with the most pollution in the world, and they need to act rapidly to solve this problem. The Chinese government has invested more than $60 billion to support the EV industry, and it's pushing more than any country to make a transition to hybrids and all-electric cars by 2035. They also invested $1.4 billion to build a better EV charger infrastructure. It's crucial to understand how popular EVs are becoming and take into account that China is one of the most powerful countries in the world economically speaking. Investors and governments are already trusting in this idea. And even though Li Auto and other companies are only operating in China, their plan is to expand and start selling worldwide. And it is true that Tesla is based in the US, but the rest of the companies like Rivian, BYD, XPeng and Li Auto are based in China. As we see in the graph, China has been the economy that has suffered the least in recent years. Other economies, such as the United States and European, have had to endure sharp falls also caused by the COVID. And in the case of Europe and the UK, the war between Russia and Ukraine, Brexit has also led to the business insolvency of many companies in the UK. This means that it is a good time to look positively at the Chinese markets that are leading the economy. Li Auto is one of the biggest companies in China's new EV market. This company was founded in 2015 and they design, manufacture and sell premium electric vehicles. They are primarily focused on SUVs. This company is betting everything on its high-end cars with a lot of technology incorporated to make driving more efficient and comfortable. Their cars have large dimensions and very futuristic exterior and interior designs that are easy to use for everyone. Prices for these cars vary by model but start around $50,000 to $70,000. However, it is difficult for these companies to lower production costs and be able to sell these cars to low-income people. But anyway, this proposition of premium environmentally friendly cars is skyrocketing, especially in China, where most companies are targeting medium to high-income people. The market share of Li Auto in premium electric vehicles in China is 20%, and the market cap is currently $36 billion, way behind Tesla. But as I said, these are companies with lower market cap and price per share. Even though Li Auto is one of the biggest manufacturers in China, this market is still in a growth phase, and companies are still having a hard time making a profit. Let's now review the numbers of this company. They have been increasing their revenue in the last few years. They made $6.5 billion, and the money spent in research and development is getting bigger. However, they are still making net losses, and the debt is still very high. Despite of the fact that they are losing money, if they continue as they are doing, just like Tesla did, they could generate profits in a few years. We must take into account that this market has gigantic entry barriers, and competing with the leaders, like Li Auto, is going to be difficult. According to Warren Buffett, before investing in a company, we have to see if they have high debt, since startups or businesses with fewer resources and high debt in competitive markets are more likely to go bankrupt in their early stages. In this case, Li Auto has a decent amount of cash, $5.6 billion. However, the debt of this company is more than double, currently $12 billion, and a retained accumulated loss of $1.2 billion. Furthermore, as we can see in last year's 10K, there are still some concerns about the cash flow and their losses for the future. After some investments that they are going to do to expand their business, there's still a chance that they may not result in revenue increase or improvement in their cash flow from operations, and this is due to the lack of demand and the increasing competition among other things. However, there's still confidence from many investors in the performance of this company for the future, because its sales are increasing year by year with a record of 133,000 units sold in 2022, which is 47% more than in 2021. Nevertheless, operating in this industry requires a lot of fixed costs to pay machinery, engineers to design and produce the cars, marketing, R&D, and light, among others. Therefore, it is of interest to the companies to sell more cars. However, they need to find a way to diminish the costs of production and in general cost of sales, because shareholders have some expectations that are not being met in the short term. The good thing is that the government is supporting a lot of electric car companies in China, and they are granting them subsidies to finance their projects. Let's now review some of the important ratios that measure liquidity, debt, efficiency, and profitability to know how this business is performing in all these areas. I already explained the meaning and importance of these ratios in the previous video, so if you haven't watched it, go and check it out. The current ratio is 2.45, which is a little bit high because they could be allocating or using these current assets in another way, but it's not a bad number. Then the debt to equity ratio is 26%. Starting a business in this industry usually requires a lot of capital from investors or institutions, so it makes sense that this number is high, but it's not as high as other companies. The inventory turnover is almost 10.8. A high inventory turnover ratio like this one suggests strong sales. Alternatively, it could be the result of insufficient inventory. As problems go, ensuring a company has sufficient inventory to support strong sales is a better one to have than needing to scale down inventory because the business is lagging. The net profit margin is -2%. Obviously, it's not good. However, it's not as bad as other companies operating in the industry that have -50 or 100%. Tesla's EPS is $3.34 per share, so there's a clear difference in profitability between these two companies. But as I said, it's not as bad as other companies in the industry. NIO, Rivian, or XPeng have lower earnings per share than Li Auto. The only thing that I want to point out is that this stock has been very volatile in the last 3 years. For example, a decline of 66% and 70%, as we can see in these graphs, in 2020 and 2022 respectively. The electric car industry is emerging globally, but the percentage of population using them is still low. Just 2% of the cars are electric. Not many people can afford to buy a car of these characteristics. Therefore, even though companies are trying to go full electric, they still need time for this to happen. Moreover, the current shortage of microchips is hurting the production and delivery of electric cars to buyers. This company went public in the summer of 2020 and raised over $1 billion through its IPO on Nasdaq. Li Auto's stock reached its all-time high last year, but it's about to surpass this value and reach a new all-time high. On the other hand, we have BYD, another industry leader, which is among the best-selling electric vehicle companies. Besides luxury electric cars, BYD also sells electric bikes, rechargeable batteries, and solar panels to the public. Also, unlike Li Auto, BYD has focused its strategy on the development of innovations that include the manufacture of batteries, electric motors, electronic control systems, and semiconductor chips. Their goal is to offer solutions that improve people's lives through the creation of a complete clean energy ecosystem that reduces the world's dependence on fossil fuels. BYD is a Chinese manufacturer in the midst of a growth career that is boosting its sales by more than 100% each year, and that will allow it to exceed 3 million units sold this year. Clearly a positive dynamic in sales increase, but also in profit margin, where it already exceeds 20%, something that makes it very difficult for it to fall in the short term. All materials and parts of BYD cars are part of BYD's production processes. Thus, they produce and have full control of all parts that make up the car, and do not have to buy parts from other brands. In fact, the economies of scale of this brand and the mass production of batteries and semiconductors are allowing them to generate income from the sale of these batteries to other brands. In fact, Teslas manufactured in Europe will use BYD batteries. One of the differential factors compared to its competitors is that BYD cars can charge their batteries at high speed, from 30 to 80% of their capacity in just half an hour. They even used more accessible and affordable raw materials to produce electric engines to reduce the cost of production. Even though BYD is not as popular in America and Europe, in Asia they are doing a great job. In fact, BYD's global market share last year was 18.4%. BYD was ranked as the best-selling electric vehicle manufacturer worldwide, after selling close to 1.86 million units in 2022, overtaking Tesla as the best-selling electric vehicle manufacturer. This company trades in the over-the-counter market, or OTC, and has $100 billion market cap, which is $65 billion more than its competitor Li Auto. To facilitate investors purchasing BYD's stock, they have an American depository receipt and 8 shares, which basically permits US investors to buy equity shares in foreign countries using the US dollar. BYD is a Chinese EV maker that is backed by Warren Buffett. Buffett owns a 10% stake in BYD's stock through his company, Berkshire Hathaway. Buffett first bought 21% in BYD in 2008, which was the same year that Tesla unveiled its Roadster electric vehicle. Buffett appears to think that BYD has brighter prospects than rival Tesla. However, in May of this year, he sold part of his stake because Charlie Munger and him don't want to compete with Elon Musk, as they said at Berkshire's annual shareholders meeting. The company has proven that it knows how to capitalize opportunities as they arise. They saw an opportunity in electric cars amid the push to curb climate change and jumped on it. BYD also diversified into making face masks when the COVID-19 pandemic started. California ordered $1 billion worth of face masks from BYD. If we look at BYD's 2022 annual report, we see that the total revenue is $59 billion US, which is 10 times more than Li Auto, but 20 billion less than Tesla. I made a little table with some of the important information. As we can see, BYD is ahead of Li Auto in terms of revenue. And after years making losses, they are already generating a positive net income. The only negative thing to highlight is the high debt they have with respect to their competitors. The current ratio in BYD is lower, so we see that they don't have enough assets to cover its short-term liabilities. Then the debt-to-equity ratio is basically the same for both companies, so the percentage owned by creditors is the same. And then the inventory turnover is higher in Li Auto, so that means that they sell and restock cars faster in Li Auto. Tesla is way ahead of these two companies, but the fact that BYD's net profit margin is positive is something to consider because most of the companies in this industry are losing money. Also, companies with high EPS, earnings per share, are good investment opportunities because they earn more than their competitors and may have more money allocated to pay dividends. We also see that the PE ratio of BYD is the lowest, meaning that the company could be undervalued. Despite of the fact that some automakers such as Volkswagen, Ford or General Motors, among others, are entering this market, we have to take into account that the entry barriers of this industry are gigantic and that these companies are more focused on cars with combustion engines. Although it seems that the electric car industry is growing fast, still with the natural resources that exist on Earth and the difficult to access materials like lithium or nickel that are needed to create electric cars, gasoline or diesel cars will continue to be sold for a long time. As China is increasingly recognized as being a major driver of global growth, investors should consider having exposure to China when building a balanced portfolio. China currently represents nearly 18% of world's GDP, but only 5% of world's market capitalization. There has been a significant flow of investment for the development of new models and new brands. It seems that we are entering a correction phase where sales continue to grow, but costs and margins adjust. A rhythm that not all companies can follow and that will mean the bad performance or even bankruptcy of some companies in the sector. However, others are doing a great job of gaining a huge competitive advantage over their rivals and increasing their sales and reputation as time goes by. If you guys want me to talk more about other companies or industries, just say it in the comments below. I really hope you liked it and that you learned some things about the electric car industry. Give me a thumbs up if you liked it and subscribe, and as always, see you in the next video.